Hello and welcome to Pro Trader Strategies market commentary for Tuesday, February the 25th. My name's Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about economic and geopolitical market analysis. I do the same things in these daily market commentaries, talking about those indicators and how they impact the overall markets. And then I layer on top of that some option strategies that I find to fit in my portfolio according to my own risk parameters. Please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with some economic data. German final GDP coming in line with expectations. That's about it for across the pond. Then we move over here to the United States, and we got our Richmond Manufacturing Index came in at -2, expected to be a +10. And remember, last month's number was expected to be a negative number. We got that 20, which just knocked it out of the park. Keep in mind, this is a good indicator of the manufacturing index or the manufacturing sectors, but we got to take all of them into account. And Philly Fed probably one of the most important ones of those indexes. We also got the CB consumer confidence that waned a little bit, coming in at 130.7, expected to be 132.6, and no revision to last month's number. We got several Fed governors speaking today, and they're really talking about interest rates and whether or not they should be lowering them. Some of them are saying that they should have interest rate cuts. Some of them are saying we should do an immediate 50 basis point cut. We also have some ex-Fed governors talking about, listen, this is a supply chain disruption, and lowering interest rates here may not necessarily help that situation. But on the flip side of it, there is an imminent slowdown as China is not really working. They are putting all kinds of crazy mandates, 4 people to an elevator, in some households, 3 people allowed to leave a day, and those type of situations to kind of get a hold of this. There is more and more places that are showing outbreaks. We talked about Oman. I forgot to mention Italy yesterday. Cairo is another one I think was mentioned today. So really starting to see this thing spread, and that's causing a pandemic across the globe and really causing the markets to start waning again today. So let's get on with the overall markets. We've got crude oil. It's going to continue to suffer as long as China is not producing. I think that they were saying that they are at basically 60% capacity right now on the manufacturing sector, so really not producing. Apple does not think that they are going to be able to get this iPhone 12 out in time, and that's really causing due to disruption in the supply chain. If they're not manufacturing, they're not building, they're not creating supply, and therefore there's no demand for crude oil. Gold is still off a little bit today. One thing I'm going to have to keep an eye on is this setup. Usually when we get these two counter-opposing dojis, that could very well signal a move higher. And at this point, I have a short GLD trade on that I'm not super happy with. As you can remember, I put on the short GLD at the 157 calls, and that is not looking too good. I was being tested yesterday and probably very close to being tested today. Bonds moving. Yesterday moved lower. We are in 100-year lows, or all-time lows for the bonds. So like if you're thinking about refinancing, absolutely now is the time to be talking to your mortgage broker and looking at refinancing. Yes, they could go a little bit lower, but I mean, they can't go a whole lot much lower. And you could always refinance again, but literally now would be the time to start shopping that if you are able to. All right, the VIX, or looking to buy a home before the home prices start spiking, because as interest rates go lower, we start seeing home prices go up, and there is a lack of supply in the housing market, so that could exacerbate the pricing wars going higher, as it is a seller's market at this point. All right, VIX back into the 25s, which we haven't seen in a very long time. So market moving higher. As you can see, we even went up into the 26, almost a full point higher. And I would expect that VIX to start moving a little bit as we're starting to see the Dow Jones really start to slide here. It was up almost 180 points at one point in time, but down about 190 points at this point. Yesterday I said that it was the biggest move down in the Dow since August of 2014. I meant August of 2014. It was from August for basically 2 years is what it was. So I misread. When we were doing the daily market commentary, it was August 14th, which is right in and around here. That was the big move there. So that's what I meant. I had just written it down August 14, and I misspoke there. And what we're seeing here is another move down on the Dow Jones today. NASDAQ down 100 points. It's been leading the way as the tech sector is really starting to get beat up on this. A lot of that has to do with China. Something to note with the tech sector, if all of these people are cooped up in their houses, there is still some limelight there where we could look at like Activision and gaming. I heard some the gaming in China was like crashing some of their servers and stuff like that because so many people are online and doing that kind of thing. So there are probably places where we could be looking for that type of growth anyway. All right, E-mini S&Ps down about 38 points, 38 and a half, and again starting to accelerate to the downside. We're seeing newer lows almost consistently. We can see that happen here on the daily chart. A little bit of an attempt to flush those guys out of the shorts overnight, but it didn't really amount to a whole lot. There was a push right on the morning, and I think that some of that had to do with coming in and some institutional buying. I think people are not really buying in strength right now. They're probably doing a little bit of what I'm doing is I've lowered my overall position size quite a bit, and I'm nibbling in and around trying to manage my overall core position that I've created through this webinar series that we're doing, where we are staying mechanical with this stuff and trying to lower our overall basis. There we go, a new low down 42. As we can see that every tick here right now is basically a new low there for the day session. But keep it small, maybe start to nibble, but if you have a lower risk tolerance and are a little bit worried about this, I wouldn't necessarily throw the towel in now, but it is going to be a pretty good opportunity to start selling some puts, maybe looking to do some dollar cost averaging. But again, very small. When I've done the webinars on this dollar cost averaging, I'm saying, if you are long, say 500 shares to maybe do 200 or something like that, I'd probably keep it to about 100. And if you have 1,000 shares, maybe even still look to sell one put in dollar cost average that way. And if we start seeing this market come off, we can really take advantage of that, especially with this high implied volatility. You're able to get out well past a 10% move. All right, so E-mini S&Ps are starting to slide. All right, well, DAL is really not looking too good, but I have on a synthetic long in here, and I've been lowering my overall cost basis in this by selling the 62.5 and 63 calls is what I've done so far in this market. And I've lowered my overall cost basis by about 80 cents, obviously not helping me with that big of a move. But with that being said, I did sell those. I had on the March 62.5 calls that I originally sold for about 47 cents. I bought those back for 7 cents today. Also, couple of other things. Looking at covering my Disney calls if it starts to bleed any more than what we're seeing right now. MasterCard, with MasterCard, I don't know why I have Morgan Stanley up here. Let's look at MasterCard. MasterCard, they always seem to make money despite the fact that we're seeing this market move down right now. I decided to jump in there and do it small, but I'm taking a stab at a couple of these underlyings that have super high implied volatility. MasterCard always seems to make money, and I thought this would be something to be able to add if we got a nice little correction here. And I went in and sold the March 270 calls in there, so you can see I'm well below where the point of control is. If we decide to go down there, break below the 50-day and the 200-day and all of these support levels, I could probably even throw up a Fibonacci and see that there's even that lines up pretty good with my outlines there. So you can see I would be in and around that point of control where the most time and volume has been spent. So I sold those March 270 calls in there for $1.24. Again, if we get any type of volatility coming out, that'll help me out. And I might look to add some more to this trade. A little bit lower strikes if we continue to slide here. But it's trying to stay mechanical with the positions and stay in this, as I think that this is a little bit overdone. I could be wrong though. So don't count on me being right on this being overdone to the downside. Also, keep in mind that past performance of any trading system or methodology is not necessarily indicative of future results. We are an educational firm, and we are talking about trades that I've done. Now, the option strategies, it's up to you to implement them into your portfolio in your own way, but please make sure you are following the guidelines that I have set on implementation of those strategies, because that will help increase your probabilities of success. But remember that the performance has its limitations, as it's hypothetical and simulated, and we are just trying to teach you in these webinars. All right, so take a minute to read over this, and that's all I got for you, other than if you can't take that, take it easy.